ahead. Affirmative 610.
Hey, everybody. Welcome back to this special episode of the Wealthy Pilots podcast. Happy to have my friend and partner, Jason, on here from WCG CPAs and Advisors. And we're going to talk today about rentals. And I have to say, Jason just released this new book called I Just Got a Rental. And what I love most about the book is the content inside. But my second favorite is, you know me as an Army guy, dude, this kind of cover is exactly, when I see this, I know this is going to be written in a language that, you know, we can all understand and get good insight from to make good decisions. So before we hop into that, Jason, how you doing?
I'm doing great. And thank you for having me on. I appreciate the time.
So, as you know, as a former pilot, there is a draw. It's such a unique industry with very, very high earnings that are, W-2 level. In a W-2 status, but yep. I mean, it's at the same level as, a doctor, surgeon, executive at a major company. But just getting paid on a W-2, there's not a lot you can do from a tax standpoint. And so I'm sure, from you starting your own side hustle that turned into the main horse, so to speak, in your CPA firm, this other draw, I think, to do something else is very common for pilots. Because I have, what's so unique, right? You have that high W-2 payout, but compared to a doctor or some corporate executive, they typically have a significant amount of time off because of the nature of their work in comparison to those other professions. So that time off, I think, what I hear frequently is, hey, I want to get into something else and use some of the capital I'm making to get a side business going. And the instant thing most of us think of is, hey, I'll get going in this rental business. So we wanted to have you on and talk about maybe some of the opportunities, but, really just some of the common mistakes to avoid and prevent folks from getting disappointed when they're on the wrong side of these decisions.
Yeah. No, it's great. And thank you for bringing that up. The good thing about rentals is that they're passive, right? You don't actually have to work at them hands-on, and we'll get into some of these details. But as a pilot, right, former pilot for the airlines, of course, the dishwasher always seemed to break when I was on the road, and all the bad stuff at home always seemed to happen when I was on the road. And with rentals, you don't have to necessarily be hands-on. With any other side gig that you're trying to build, let's say to either augment income or to transition into after you retire, a lot of that stuff is hands-on. Even if you wanted to sell real estate, even if you wanted to, install gutters, whatever. I mean, just think about the myriad of different businesses that are out there, or side hustles that convert into your mainstays. They need you to be there, right? You need to be there pounding the pavement. With rentals, not so much. You can operate your short-term rental from Mars, right? It's a laptop. It's your VRBO Airbnb account, and you got a property manager, and you're just basically a coordinator at that stage. And you can do that anywhere. You can do that from a hotel room, crew lounge, or in the comforts of your living room, right? So that's what makes rentals, I think, attractive as well, is that, there's maybe a little bit hands-on in the beginning. You buy the rental, and you got to go over there and maybe paint it and outfit it with furniture if it's going to be a short term or something like that. Maybe you take a week off and you time it right with your schedule, so you have 3 or 4 weeks off in a row, and you bang out all the things you needed to do on this rental, right? But after that, it's kind of on autopilot, bad pun, sorry, pilots, but it is, it's a lot of work, but it's not like you have to be there hands-on. I know a lot of people that operate rentals 2-3 time zones away. Okay, so it's not something you have to have in your backyard. It is nice to have it in your backyard, but you don't have to have it. So back to the original question, one of the top 3 mistakes I think people make with rentals is, number one, is thinking that a rental is a tax vehicle. Okay, a rental is a wealth building vehicle. And if we can save a little bit of tax along the way, then that's just great. And so I think people go into it from a tax perspective, and they really need to go into it with a wealth building perspective.
But Jason, now, I thought property tax, depreciation, all the money I'm putting into it, travel to it. I thought this would be an easy win for my tax situation. No?
Sure, that's not wrong. But all those deductions that you rattled off, you have to write a check for.
Mm-hmm.
You have to take, except for depreciation, right? And we'll talk about that here in a second. So, but you're right. People sometimes will go into a business thinking, I'm going to create all these write-offs to shelter income. Well, if your business loses money for 3 years in a row, the IRS will deem it a hobby. So you have to have a profit motive, if you will, right? With real estate, it's kind of inherent that you have that motivation because you're renting it out and all that stuff, even though it ends up having a loss every year for probably several years.
Mm-hmm.
But I just caution people from thinking that this is going to be this massive tax windfall. And here's why. Rental activities are passive by nature. Okay, Jason, what does that mean? That means that under the current tax code, if it's a passive activity, you have income limitations such that you cannot take your passive losses against your W-2 income. So if you make more than $150,000 as a household, which is going to be the vast majority of pilots listening to this podcast and anybody who's, let's say, in an executive position with their firm or a company, your losses from your rentals will not be deductible unless you pull a couple levers, okay? So just in general, you have a rental, let's say it has a $20,000 a year loss, that is going to be carried forward into the future. Unless you have other rentals that actually make income, right? But let's just say you have one rental. Those losses are just going to be deferred into the future. So they're not actually going to be a reduction of your other taxable income. Unless we get into two things, the short-term rental loophole or the other is real estate professional status, REPS for short. We'll hit REPS first because it's a bit easier to maybe dismiss, if you will. With reps, the general rule is you have to work 750 hours in real estate activities, and then more than 50% of all your activities have to be in real estate. And right in the IRS Audit Techniques Guide, what we call the ATG, is if the taxpayer has a W-2, there is a strong likelihood that they are not able to put more than 50% of their effort into real estate activities because of this W-2 job, right?
Yeah.
Now, pilots are unique, right? Pilots can say, hey, wait a minute, I'm flying 1,000 hours a year. I'm on duty for 1,500. I'm not working basically a full-time job, right? Or even maybe you're flying even less, right? You're flying 700 hours on duty for 1,100 or something that you can argue that you can show that you're spending more time on real estate than you are flying airplanes. Yeah, it's really tough, Scott. Really tough to come up with that defensible argument. So what a lot of my pilots do, and not just pilots, but let's say we have a spouse who's not working, right? Well, that's the perfect real estate professional status. Now we can make him or her the real estate professional, and by that designation, that allows you to take those rental losses against your W-2 income. Okay, and I could talk for hours on just reps alone, but that's super high level, 30,000 foot perspective, right? Let's get into the short-term rental loophole. The short-term rental loophole is not really a loophole of sorts. It's a portion of the tax code that basically says, hey, you're not really operating your rental like a rental. You're operating your rental more like a hotel. And a hotel is a business like any other. And should you have losses in your business, you can deduct those losses against your active income, which is your W-2 income, let's say from your job. So to qualify for the short-term rental loophole, two big things. You need to have an average guest day of 7 days or less, and you need to participate in the activity on a material basis. So material participation is a big buzzword in rentals. Mm-hmm. And there are 7 tests for that. the big three that we always focus on is you spend 500 hours on that rental activity. That's a lot. That's 10 hours a week. That's a lot.
Yeah.
Or 100 hours and more than anyone else. And that's quite literal, anyone else. So you need to track the cleaner's time, not just the cleaning company's time, but like the individuals doing the cleaning, the repair people, the landscaper, all this different stuff. Provided that you spend 100 hours and more than anyone else, again, very literal on a human-to-human basis, then you are considered materially participating. So we have a 7-day average rental and we have participation. You combine those two together, those losses now can be deducted against your W-2 income.
And that's what you just described, I think sounds like more work than what most people are going to want to track and whatever, right?
I don't know. I'm not saying you're wrong, but I can't fully agree with that because a lot of the property managers out there, they know this rule, right? And to make them more attractive, because property management is a commodity, right? You're sitting there, you buy a house in Big Bear, you buy a house somewhere on 30A in Florida, all these hot spots, right? There's property management companies everywhere.
Right.
And they're competing for your business to help you market and rent out your short-term rental. And they'll say, hey, look, we understand what you're trying to accomplish here. So we're going to track all of our time by human. And then all you need to do is track your time, right? And so actually it's kind of nice.
So as long as you're using a property management company, that could seem, and you got to be disciplined with tracking your own time too.
Yep, exactly. Yeah. And I know we also have a lot, and this is all in my book as well. I have a lot of owners who they don't have a property manager because they're like, it's expensive and blah, 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 blah. But they'll have the cleaning lady or person, they'll have the repair people, they'll have the landscaper, all these different things, right? And they'll give them different door codes. And then they can download the data from their cipher lock. And so, 4562 entered in at this time on this date. 4562 exited the building and locked the building on this time and date. And then it spits out, that whole thing based on cipher lock or door code. It's a real simple way to track people's time is to give everybody a unique identifier, basically, right? Yeah. So anyway, it's a pain, yes, but I don't think it's as big of a deal,
But you need a system for it. Yeah, you need a system for it. Yeah. Now, what about outside of the short-term rentals? Like somebody who's just thinking, hey, I'm not looking at this as a vacation home. I'm just trying to stack up a couple smaller, either duplexes or something like that. Is that also a way that you would look at as, hey, this is a great way I can drive a lot of tax efficiency? Or is that also like, hey, this is wealth building?
Yeah, totally. Yeah. There's only two real ways to enter into that tax deduction world, and that's short-term rental loophole or real estate professional status. So if you want, I do have pilots that have a series of long-term rentals, especially my military guys, right? Because everywhere they PTS out or whatever to a different place, they left behind a home and converted it to a rental. Yep. So by the time you're 40 years old, you got like 6 rentals behind you, and they're all long-term rentals. They get a tenant in there and everything's great. That's where a real estate professional status is going to come into play. And when you have more than one rental, there's what we call the 469-9G election, and that is a reference to the tax code where it allows you as a real estate professional status to group, let's say, those 6 rentals together as a singular activity. That way, when you're looking at your 500 hours or your 100 hours and more than anyone else, and there's another one in there, a threshold of substantially all hours to be materially participating, when you group them together, it's considered one activity. So you don't have to spend all that time on each rental. separately, which is helpful because if you have 6 rentals, there's no way you're going to spend 500 hours on each.
Right.
And it might not even be the case where you can spend 100 hours on each. But if you group them together, then you might be able to easily hit the 500 or the 100 hours and more than anyone else.
Hey everyone, real quick, if you haven't grabbed Scott's Financial Flight Control Toolkit yet, now is the time. This is packed with tons of helpful resources and tools like this, Scott's book, The Dichotomy of Wealth, which is a pilot's guide to maximizing wealth and cash flow in retirement. You also get access to some great guides like this one, Advice Matters, which breaks down 4 key ways a good financial advisor can help you boost your returns over time. And guides like this one on the pitfalls of emotions when it comes to investing, and this one on the HCM byline investment strategy, and more. So if you'd like your very own Financial Flight Control Toolkit, just click the link in today's show description, and Scott and the team will be happy to get one sent your way at absolutely no cost to you.
And really what we're trying to unlock here is being able to get ourselves above these really high standard deductions. Is that right? I mean, because I think if I got one small long-term rental, regardless of what expenses I'm incurring there, even still, I might not hit the standard deduction.
Well, this is outside of that because this deduction is separate from your standard deduction. The 29.6 or 30,000 or whatever it is for a married couple, that is outside of that. So you still get that deduction all day long in addition to your rental losses. Let's just go into cost segregation for a hot minute. And this is going to be a brand new resurgence in cost segregation because 100% bonus depreciation is back. Mm-hmm. And what does that mean? Okay, I just got done saying a bunch of words that haven't been defined yet. So with cost segregation, these engineering firms are going to look at the home and they're going to take all the property and they're going to put it into different depreciation buckets. They're going to put some of it in 5-year, some in 7-year, some in 15-year, and then the rest, let's say it's a long-term rental, is going to be 27.5 years. What does that do for you? Well, when you have the 5, 7, and 15-year depreciation buckets, you can elect to bonus depreciate all of that at once and deduct it against your income, which is huge, right? So let's just do some quick math. Let's say you have a $400,000 building. So you bought a rental for $600,000, land is $200,000, you got a $400,000 building. And let's say your cost segregation identifies $80,000 worth of 5, 7, and 15-year property. You can then take 100% of that $80,000 and deduct it. Now, $80,000 times, let's say, a marginal tax rate of 35%. Quick math, let's just call it $30-some thousand of cash in your pocket.
Yeah,
that's pretty big. Now we're moving some needles, right?
Yeah.
And then you use that cash that you save on your taxes to redeploy into other wealth building things. Whether you help them invest that, whether they buy another rental with it, do something with it, right? That's where tax savings can help build wealth.
And I think that's where we start to stack up the strategies too. And, maybe somebody who's recently retired, you might look at, hey, do we combine that with, a Roth conversion at the same time? Or do we combine that with some other mega Roth conversion and a contribution for a donor advised fund? And you kind of batch those things in 1 year. And that's where I think the bringing in the planning, the tactics, and tying it to that strategy all at one time. I mean, I would think, at least with a lot of what we work on, and I know you guys too, when you bring it together, it's pretty common you can make, 6-figure impacts on, pretty simple cases. When you're not talking about, 10, 20 millionaire people that you can still make a huge tax difference in. Maybe not every year, but by batching some stuff.
Yep. No, you're absolutely correct. And timing is everything on that. I mean, it's good that you bring that up because, pilots maybe not so much because their income is pretty steady. I talked to a couple yesterday, each of them make about 600, 700,000. So pretty decent household at 1.3 million. And like for them, timing is right now today. Let's get your max tax deduction because it's not going to change next year. And where I'm going with that is, let's say you have a pilot, and they're making 200,000 because they're just starting off, or they're an FO or something. They're going to upgrade and all these things, or their spouse is going back to work. I'm making these facts up, right?
Yeah.
But let's say next year is going to be a considerably higher income year. Like they're going to go from 250 household to 700, right? Well, let's delay that big bonus depreciation deduction until next year. Let's not do it this year.
Yeah.
And that's probably another mistake that I see people in lower tax brackets, let's say 22%, and they want to like lower their taxable income down to zero or some really low number, right? And I'm like, man, that 10% and 12% tax brackets, I'm not saying it's free money. It's still taxes that you have to pay.
Right.
But it's so low. It's so low relative to the 32, the 35, and 37.
It's painful up there.
Let's not go down to zero.
Yeah.
Let's try to go down to a spot that makes the most sense, not just today, but also next year and the year afterwards.
Yeah.
Because that's the problem with some of this accelerated depreciation or bonus depreciation, is it's a one and done. You don't get to do it again next year, right? So you kind of want to time it. You kind of want to be smart with that. And that's probably another mistake that I see is people pound the max, kind of like the old union chant, max pay to the last day, right? It's kind of the opposite, the max deduction today. And it's like, wait a minute, my job is to help you save taxes over your lifetime, not just a point in time.
Right.
And that might not be the answer you want, because everybody wants everything now and they'll worry about next time, right? But, you and I are like, wait a minute. You got like 30 more years on this rock. Let's be smart with it.
Well, and I have never, ever talked to one of my high net worth retirees who did not wish they had more money in a taxable brokerage account and a Roth. They don't look back and say, oh my gosh, what keeps me up at night is what I paid in income taxes in 1994. That's not what keeps them up at night. What bothers them now is like, every dang time I got to touch this old 401k or this IRA, I got to go pay 30% to get the money out. And they hate it.
Yeah.
So.
Well, and I'm a huge fan. You and I have talked about this, I think, in the past as well. I'm a huge fan of after-tax qualified accounts, the Roth account.
Love it.
And in my book, I actually talk about that. Let's time this big cost segregation plus bonus depreciation plus short-term rental loophole and rep, because you have to stack all that together. Yeah. Let's time that with other things. Let's do that Roth conversion, So yeah, I agree 100% with that. With rentals, there's a point in time, right, where we want to take our fixed assets and convert them into fixed income, right? That's always like when you start hitting your 60s and 70s and 80s, you don't care about assets as much as you care about income.
Right.
And rentals just provide that, right?
Yes.
And you can always pluck a rental off, right? You got 6-7 rentals. Let's say by the time you're 60 years old, you're sitting around, you're 70 years old, and you're like, look, we need $500,000 right now. We want to pay off our house. We got this other ambition we want to do. We want to buy a second home, whatever.
Yeah.
Let's go ahead and sell that rental off and flip it around to a lifestyle choice that we need to make at the age of 70. It's a great way to be able to just sell off quickly an asset and get a fast injection of cash.
Yeah, absolutely. So as we kind of wrap here, I guess what comes to my mind, Jason, would be, in your opinion, who would be the person that's like a really good fit to go down this path of buying a rental? And then who do you think should just absolutely avoid it? Because I do think there are folks that are like, I need to do this because I heard someone else talk about it. Like you said, in the lounge, in the cockpit, whatever. But they, for whatever reason, their personality type or their, lack of wanting to do all the things that you mentioned, just absolutely shouldn't. So just as we kind of wrap us up here, what would you think about who should maybe strongly consider going down this path, and then who should just absolutely avoid it?
Yeah, so great question. I'm going to throw my wife on the bus for a little bit. And I think you can probably hear me just down the hall a little ways. But we left her home. We came together both with homes, right? And we went off and got our own home, but we converted our existing homes into rentals. And, she would occasionally drive by her former home when it was a rental, and she'd be like, "Oh my God, there's weeds in the yard, and they're not. Oh, they got all these cars parked outside. And that one's dripping oil, and you can't do that to yourself, right? So you have to look at this as a business deal, and every business deal is going to have its good days and bad days, and you have to be able to keep your eyes on the long-term prize. And when that furnace goes out and you got to write a $6,000 check, that's not the day to wonder if you should be a landlord or not.
Yeah.
You know what I mean?
Yeah.
So I think if you're going to get bothered, and I'm not saying you shouldn't, but if you're going to get bothered to the point that it keeps you up at night, it maybe interrupts some of the other things that you do in life. If you're sitting there running a checklist and you can't get your mind off that $6,000 check that you wrote for the furnace, maybe you're not fit to be a landlord, right? Yeah. The other thing I would say is property managers. I know they cost money, and in a long-term rental environment, let's just say they cost you 10%, right? A couple of things to consider is they usually garner higher rent, let's say by about 5%. So they're already paying for, let's say, half of their fee. But what I liked about them when I used them in the past is I can put my head in the sand, especially on that long-term rental, right? My long-term rental is a wealth-building asset. I don't need to be in on the daily grind on the ops. So I said to my property managers, look, anything under $1,000, just get it done and debit my account, right? I don't want to know about it, hear about it. I don't care if the screen is ripped. Just fix the darn screen. Don't tell me about it. I got better things to worry about.
Yeah.
So I think that you have to have a little bit of a stomach for this, because it is a business. You can't take things personally. Yes, it's your money. I get it. But no different than funding your 401k with your money. When you occasionally have to write that $6,000 check for the furnace, consider it funding your 401r, your 401 rental, if you will.
Yeah.
You're just feeding your asset so it can continue to build wealth and also throw off some cash.
Yeah. Good. Awesome. Well, I'm going to include a link to your book here in the show notes so everybody can get out to go see it on Amazon. I highly recommend you pick up a copy and thumb through it and tag it. And then obviously in the book and in the show notes here too, there's going to be contact information for Jason and his firm. So, as we kind of close it down here, what parting comments would you have for everybody as they get ready to embark on the rental path, or if they already have some rentals, what's a good action step that they can take just to make sure that they're really taking advantage of all the tax advantages that do exist for them?
Yeah, good question. I the first thing is to get on some of the forums and to just look at other people, do your homework, and talk to a tax professional, and not just any tax professional, but somebody that actually likes real estate. I am a landlord. I've been a landlord for, probably 30 years. I've owned rentals. So I think you need to have an advocate that can kind of help you out with that stuff. I think that's just make sure you have your people in your court that understand what you're trying to achieve and work together with them.
Awesome. Well, hey, thanks a lot, Jason. Appreciate you taking time to come with us and share your wisdom with the group. And folks, I'm telling you, if you're not working with somebody, you got any doubts, reach out to him and his team. You will not regret it. So
thank you, Scott.
Well, that's it for this week. Thanks, everybody. We'll talk to you soon.
Information is for illustrative purposes only and does not constitute tax, investment, or legal advice. Always consult with a qualified investment, legal, or tax professional before taking any action.